Hi guys, for the 2022 CFA L3 exam, which is just I think so the 31st August exam is just 14-15 days away. What I've done is I've collated certain last moment revision points. So let's go through it. I would suggest you go through it on the in the last week. So this will be like a refresher because most of the formulas are very confusing and it's a lot of things to remember. So I've just collated a set of important points across all subjects. So let's get started. Okay, so we all know what is the duration and the convexity, but for option embedded bonds, we will use effective duration and effective convexity. This is coming from L1, L2, so nothing change over here. This is the return attribution for fixed income portfolios. So the return of a fixed income portfolio can be attributed to the income yield, which is your coupon by the current bond price, the roll return, which is the future price minus current price divided by current price, very simple. And the combination of both of them is known as the roll yield, which is the roll return plus the income yield. Change in price has the same formula from L1 and L2, which is the duration into change in yield plus 1 by 2 into change in YTM the whole square into convexity. The change over here is in the change in spread. So earlier we were given directly a number for credit spread. Over here you might be given a change in spread in the question. So then you have to compute the credit risk. So what you can do over here is use the same formula for the change in price. Just change the change in YTM with change in spread. Or you might be given the PD and the LGD, which is the probability of default and the loss given default, and you can compute the expected credit loss. And the final attribute is the currency gain loss. So pretty much everything is same, only the change is over here, which is in wherein we are using the credit spread. Leverage return. So there are ways to do leverage returns in the fixed income bond portfolio, wherein you can enter into a repo and reverse repo kind of a transaction, or you can enter into fixed to floating or floating to fixed interest rate swaps, or you might just want to do hedging of your bond portfolio, but you don't want to put in the entire amount. You would go for a bond futures, or you would do an SLB, which is a security lending and borrowing. So the formula is quite simple over here, which is the leverage return is a combination of the return on investment plus the leverage ratio, which is the borrowing upon the equity, multiplied by the difference of investment return minus the rate of borrowing. So whatever loan that you are taking, at whatever rate it is coming, you have to subtract that from the rate of investment and multiply it with the leverage multiplier. That's it. It's very simple. Convexity, over here we have highlighted this to make you understand that convexity can be computed as a sum of macular duration plus the square of macular duration plus the cash flow dispersion divided by 1 plus IRR. Now over here you can see if the cash flow dispersion is more, the convexity will be more, right? We have read this in across the entire subject, so I'm not going to repeat that part. Cash flow dispersion is more, convexity is more. You can make it out from this formula. Then we have something called as spreads over here in fixed income. So what is a butterfly spread? If the question only mentions butterfly spread, it is by default a SLS kind of a transaction. So what is SLS? It is short, long, short. Okay. So I'll just delete this and redo this again. Short, long, short. So you'll short the near wing, you long the mid wing, and you short the longer tenure of the bond portfolio. So in the yield curve, you'll do like this. So the yield curve will actually look like this. It will go like this. It will slowly start to rise. So this could be a butterfly spread. Now there's confusion over here. Sometimes in the question they mention the twist, sometimes they mention the spread. So if nothing is mentioned, butterfly spread is mentioned, it is simply positive butterfly twist. Positive butterfly twist. So whenever you are doing an SLS transaction, short the wings, long the body, it's a positive butterfly twist. The opposite is true for a negative butterfly twist, which is short the body and long the wings. So in case you have a scenario wherein you want to take advantage of the yield curve, you might want to do something like this. Just change the pen itself. You might want to do something like this where you're longing the long tenures and shorting the mid tenure. So in case your view of yield curve is that the yields will rise in short term, but eventually due to the long term average, it's going to fall down. So you'll take a long position over here where the yields are lower, here where the yields are expected to go down, and here a short position where the yields are going expected to go up. So you benefit when the price goes down. So repeating it again, butterfly spread is a positive butterfly twist, SLS. Negative butterfly twist is positive butterfly spread is equal to negative butterfly twist, and which is the LSL. So you can just remember butterfly spread is SLS, the opposite will automatically come to you, right? It's unnatural. Secondly, we move to the number of bond futures. This is similar to the last part that we had run through. So over here, in case you want to take an exposure in the bond futures, how many bond futures you need to purchase, right? So in order to match the duration, or in order to increase the duration, you need to purchase the bond futures. In order to decrease the duration, you need to sell the bond futures. But how many? So the formula says it's BPV of liability minus BPV of assets upon BPV of CTD. And whenever we know that whenever there is a CTD, it has to be multiplied with your conversion factor so that it becomes closer to the actual bond. And the formula for BPV is duration into 0.01 basis points into the market value. So duration BPV of liability minus BPV of assets upon the BPV of CTD. Quite simple in that sense. Then we had the concept of laddered, bullet, and barbell portfolios. Just to freshen it up from the last year, I'll just take this. I'll take a pen, yeah. So this could be a laddered portfolio, starting from 0.5 tenure to say 10 years maybe. This is your barbell portfolio. It will be at 0.5 and 10. And then you might have a bullet portfolio, which will be concentrated between 8 to 10 years. Example. So this is your laddered portfolio, your barbell portfolio, and this is your bullet portfolio. Let me make it a more cleaner this time. Let me attempt to make it more cleaner. This is your laddered portfolio. This is your barbell portfolio. And this is your bullet portfolio. Okay. So for the first part, which is a laddered portfolio, laddered portfolio is diversified between reinvestment and price risk. Why do we say this? Because we have a lot of number of bonds which are maturing on a regular interval. So whenever we have an exposure in the fixed income asset class, we are exposed to the yield curve shape, right? Where however the yield curve is going to shape, that is going to expose us to two risks, which is the price risk. The second one is the interest rate risk, right? So laddered portfolio, since it is diversified across the tenor of the yield curve, it will give you a much better diversified portfolio. Now over here, we have to remember two things. If horizon is greater than your duration, then you have a reinvestment risk. So suppose you have a bond portfolio which has a duration of 5. Let's hypothetically mark it over here. And your duration and your horizon that you want to hold the bond portfolio only for 4 years. So now your horizon is less than the duration. Now since the duration of the bond portfolio is 5 and your horizon is 4, which is less than 5, your interest rate risk is still taken care because you still are benchmarked or following a 5-year or a duration 5 portfolio. But in case you sell your portfolio here, now you'll have cash in your bank. When you sell the portfolio, you suppose you get $10 million in your bank. Now you will be open to what? You will be open to the price risk, right? Because you have sold before the duration of the bond portfolio or whatever benchmark you had. Similarly, if you sell it after the duration bond portfolio, suppose now your portfolio duration is greater than your suppose your horizon is greater than your duration. Now your interest rate risk is more prominent. Now your interest rate risk is more prominent because now you're above the duration, the benchmark duration or the portfolio duration. So it's simple. If duration is greater than horizon, you're exposed to the price risk or the reinvestment risk. And if the horizon is less than the duration, then you're open to the price risk. I hope I said it in the right order. But what if a portfolio manager has a view that there's going to be no change in the interest levels, right? He says that I am not able to gauge whether it's going to go up or down, but in my view, it's going in the short term to the medium term, it's going to be the same. So in that sense, just to be hedged on the both the sides, the portfolio manager will try to become duration neutral. Now, how do they become duration neutral? They enter into spreads, right? We know from derivatives that whenever we do a spread, we try to hedge our risk. We try to become more neutral, right? So they do it through spreads. So butterfly strategies are duration neutral. So we just read this, right? Negative butterfly twist LSL, right? Here only we read this. Negative butterfly twist LSL. Short the body, long the wings. Long wings, short body. Increases curvature, butterfly spread increases. The positive butterfly twist is obviously opposite of that. Again, some concepts from level 1 and level 2. Covered interest rate parity is the forward rate can be derived from the spot rate and the ratio of the interest rates of the respective currencies. And the uncovered or the uncovered interest rate parity is just says that the higher interest rate currency should offset and depreciate on to the interest rate differential. So if you have dollar and you have INR and INR has higher interest rates, we have seen that INR has depreciated against the dollar, but that doesn't mean that UIRP actually holds. There could be multiple reasons why INR must be depreciating against the dollar, but theoretically that is the concept of UIRP, that the interest rate the currency which has the higher interest rate, it should offset by depreciating that much, because then otherwise there will be an arbitrage, right? The parity means that there should be no arbitrage, zero arbitrage. Okay, now we'll focus on the spreads. So to make it more intuitive, let us also highlight this part and let us go back to our drawing board. So the first is yield spread. So before that, I'll just create a good yield curve so that we can understand this. And we'll try to mark the government bond with the red color, okay? Okay, now the first one is the yield spread, which is the YTM of corporate minus YTM of government closest maturity. So suppose you have a government bond which has a maturity of say 8 years over here, and you have a corporate bond in your portfolio which is say 8.5 years, and you have another government bond which is say 10.5 years. So this bond is closer to this bond in terms of the duration or the maturity, no, the residual maturity. So you will take the difference between these and you will mark it as the YTM or the yield spread. Okay. Then we have the G spread. Again, it is the same over here, but what this time it will do, the G spread, it will try to interpolate the short maturity and the long maturity. So now you have a corporate bond which is between two government bonds. In the YTM, you took the closest one. In the G spread, you take the interpolated value. The interpolated value. And there is a very simple formula to calculate the interpolated value, which is 1 minus W into M1 plus W into M2, where M1 is the lower maturity and M2 is the higher maturity. So here M1 is this one, M2 is this one, and the formula is simple: 1 minus W into M1 plus W into M2. So this will give you the weight of each of the yields, and by multiplying the yields weight, you will come to a final value. I spread is again similar to the G spread, but over here you use the swap curve. So we have the swap curve in the interbank market. Not looking a good curve, so let me draw it again. Yeah, you have a swap curve in the interbank market. So now what we'll do for this corporate bond, which is marked in blue, I will take interpolated value of swap rates. So this is a swap rate 1, this is a swap rate 2. So for this corporate bond, I'll take the interpolation of S1, S2, again following the same formula which is mentioned above for interpolation. Then we have the asset swap spread. Now the asset swap spread is a slightly different, so we'll have to create this yield curve again. Okay. So over here in the asset swap spread, we are saying that the coupon of the bond minus the YTM swap interpolated. So suppose you have a portfolio which has on the swap curve, it is having a coupon of say 5%. You have a bond portfolio which has a coupon of 5%. You will take the interpolated value of two closest swap yields, right? So that will be your asset swap spread. Z spread cannot be computed manually. It's a trial and error method, which is a rate which is added to the spot rates, and it will compute the it is that rate which equates the current bond market price, okay, by discounting it. So we don't need to actually go and calculate it. It will be given. Option adjusted spread is, it has no impact of options. So to understand it in brief, I'm not going to go in detail because this is from L2, L3. Whenever we used to do decision trees, we had all these kind of things, right? Upper node, lower node, and all those things. So at each node, we are taking the probability of the option either being exercised or either not being exercised, right? No exercise. But if the option is already exercised, that means option adjusted spread already has the impact of options. So you don't need to add it back. So option adjusted spread is the one which has no impact of options. It is option adjusted. If in the exam you are given option adjusted spread and any other spread, always go for the option adjusted spread, because it is the only correct measure that will give you all risk adjusted spread, that is credit risk, liquidity risk, and options adjusted. Then we have a concept called as DTS, which is the duration time spread. As the word says, you just have to do the same thing. Duration, which is effective spread duration times spread. Simple. Effective spread duration into spread. Now this is important in terms of ECL, where we used to calculate the ECL. So we have it in the next point itself, excess spread, which has a simple formula which is S into T, where S is the spread, T is the time for which you want to predict what will be the spread, minus the effective spread into change in spread, minus the ECL. Now ECL over here is given as probability of default into loss given default. So ECL is more or less will be given directly, or if not, these two variables will be given in the exam, which is the probability of default and the loss given default. This new concept is new in L3 this year. So we'll just cover this in brief. So discount margin is a constant margin spread over MRR. Okay, let's understand this briefly again. So suppose you are planning to take a loan. You can take a loan on fixed basis, say 5% for the entire tenure. Or you can say, no, okay, I want a loan which gets resets on periodical basis, and that would be a floating loan, right? Now floating loan has two components. It has MRR, which is the market reference rate. In that case, it will be LIBOR. But this is the rate that everyone is going to provide you, right? Because this is a market reference rate and it is not as per the counterparty credit risk. This is just saying that to borrow at the minimum rate of market is the LIBOR rate or the market reference rate. But anyone who's going to give you a loan is going to adjust for your credit risk, or he just wants to make market, or he wants to make profit. He will say, okay, I will charge you 20 bips above the MRR, right? Now this is your discount margin. the constant spread over MRR. Now, if the yield curve moves upwards, now in this scenario, now if the yield curve moves upwards, what will happen to this? If the yield curve is moving upward, this will increase. Say suppose this was 4 earlier. My pen is not working properly. Yeah. Suppose this was 4, now this will become 5. Now, just from the logic, if the yield curve is moving upwards, the Z spread of the discount margin will be lesser than the DM. It's quite intuitive in that sense because this DM is fixed, right? If one of the component is increasing, the other component has to decrease, right? So as to maintain the present value of the bond. Similarly, if the yield curve is going downwards, this will become 3 from 4. If this is becoming 3, the other component, which is the ZDM, has to increase. It will be more than DM. And what is ZDM? ZDM is analogous to Z spread, right? I forgot to explain ZDM. ZDM is analogous to Z spread, wherein it's a spread that is added to make the present value of the bond equal to the market quoted price, right? So analogous to Z spread, but in terms of a floating loan. Then we have the Altman Z score, which is again for credit risk. You can say it as a credit risk or the probability of failure or probability of default. Now over here, we don't need to go through the entire whatever scoring mechanism that they have given. We just need to understand and take the inputs from the equation that will be given in the exam and just infer one thing, that if it is greater than 3, no chance or very less chance of default. Below 1.8, very likely to default. And if the score is between 1.8 to 3, there is some default risk, but it's not a confirmed default risk. So it will be put on the watch list. Below 1.8 will become non-investment grade. It will become a default grade. Greater than 3 will become the investment grade. Again, we have gone through this in level 2, level 1 again, structural model and the reduced form model. It is basically again used to identify the credit worthiness. Just try to understand it from an exam perspective because these models needs to be studied in detail and the books are not giving that much of detail, right? So structural model in a broader sense will take the balance sheet ratios and see how the company cash flow or the company cash or the assets are structured, right? It will try to give a probability of default. And the reduced form model is doing the same thing, but it takes the impact of macroeconomic relationships on the overall economy and the business in the business cycle itself. So don't get into a lot of detail of what are these, just try to understand the difference between them, right? This year in L3, there's a lot of focus on credit spread and yield spread, so that will be a more testable material. So they have included a lot of things over here. The last part of the fixed income is the credit spread or the CDS, credit default spread. Now let us understand in a basic terms again, just to refresh, what is a credit spread. Now suppose we'll take an example. Say suppose in India, let's say we'll not take an Indian example. Let's take an example. There's some housing company in US which has issued some bonds, right? Some housing company in US which has issued some bonds. Now these bonds will have all the inherent risk like credit risk, market risk, etc., etc., etc. Now if this bond issuer is currently doubly rated, right? There could be two investors. One who says, okay, I don't see this getting degraded. But investor 2 says, hey, wait, I see this going to A. I see this going to A or maybe triple B. So they both have opposite views. This could be an investment bank, which is very sure that, okay, nothing is going to happen to this bond. This could be an institutional investor saying, no, I believe that the housing market is going to cool down. These guys are going to go out of money and there will be a credit migration from AAA to A or AA to A or triple B. Now both have opposite views. Now he will say, okay, I am sure that this is not going to happen. but he'll say, okay, I am sure that I'm going to lose my money. I need some insurance. So he'll say, okay, I will sell you this insurance. So this guy will sell insurance to him, and this guy will be protected because he has bought the insurance. He's the one who's bought the insurance, and this guy has sold the insurance. So like in our own lives, right? What happens when someone sells you the insurance? You pay the premium to them. You pay the premium to them, and they will receive the premium, and they will give you the protection. Now say after 6 months, one of them has to be right? Otherwise, there's no point. One of them has to be right. Either the credit migration happened or it did not happen. Now, if it happened, if the credit migration happened, this guy will be protected because he is insured. He has paid the premium. He is insured. And if the credit migration does not happen, the maximum this guy can lose is his insurance premium. But what happens between this period? There is something called as valuation, right? Mark to market valuation of the bonds. Now maybe say from double A did not go to triple B directly or A directly. From double A it went to AA minus. Now AA minus is a downgrade. Now since it's a downgrade, there will be a change in spread. There will be a change in spread. Earlier, say suppose the credit spread was for 20 basis points. Now the spread has widened because the rating has gone from double A to double A minus. Now this change in spread is positive. The change in spread is positive. Whenever there is change in spread, this guy will make money because he is saying that I want to be insured for any credit losses. So in the system, or in the USA system in that sense, not globally, the investment grade bond is quoted at the 1%, and a high yield corporate bond is quoted at 5%. So this, if not given in exam, but will be given, mostly it will be given because they don't want to test your memory as such. But if it is not given, just keep in mind that if it's an investment grade bond, the coupon that will be received will be 1%. And if it's a high yield bond, you'll be receiving a 5% coupon. Now, if the CDS spread is greater than coupon, then upfront premium to be paid to seller. Why? See, the coupon that you're getting on the bond is, say, suppose 5%, and the spread that the seller is giving you is basically 6%. Now the seller is giving you greater than the coupon that is already being paid to you. So the difference of 1%, you'll have to give it back to the seller, right? So the formula for that is simple: CDS spread minus coupon into the effective spread duration. If you see, what is this? This is simply duration into change in YTM. Nothing changed, no difference over here. What is change in YTM? Change in YTM will be CDS spread minus the coupon into spread duration. Same formula over here. And to compute the CDS price, the formula is 1 plus fixed coupon minus CDS spread into effective spread duration. So if you just have a look at all these three formulas, there are only three components: coupon, CDS spread, and the effective spread duration. You just have to place it in different places to get the amount. One way to remember this is, if the seller is paying you more spread, if the seller is giving you more spread than the coupon, you'll have to pay it back to the seller. You have to pay the premium difference back to the seller. And if the seller is giving you less than the coupon, then the seller will give you extra money because now he's giving you lesser than the coupon itself. One more way to compute the CDS price is the 100 minus upfront premium. So if in the exam you are not able to remember this formula, but you know how to compute the upfront premium, which is this one, just do 100 minus upfront premium and you will be arriving at the price. So with that, we end the fixed income. Let's quickly move to the equity part. In the equity, most of the items are very similar to L1, L2, and it's more conceptual. So if your base concepts are clear, I don't think so equity will be a problem. But there are some new items that we need to discover or discuss. And these are some things that can be tested because they are obviously new items. So the first item is the buffering and packaging. So buffering and packaging, let's understand from an example, simple example. So if suppose you have an index of 500 stocks, right? This could be large cap index, and then there could be an index of 2000 stocks, and this could be the mid cap index. Now there are two ways a stock can enter from one index to another, which is buffering and packaging. Now suppose this has index of all companies which is more than 4 billion of market cap, and this is index of all companies which are from 2 billion to 4 billion, just for an hypothetical example. But now there is a company over here which has crossed 4 billion, just crossed 4 billion, and now is maybe at 4.2. Now this the fund managers or the index management companies or the exchanges will say, okay, here is a company which is increased in market cap and should be included in large cap, but this could be very volatile, right? It could be 4.2 now. Tomorrow, if the market goes down, it can become 3.9. It will again become a mid cap. So to avoid this confusion, what they say is, okay, we understand that you are above 4 billion, but let's say you cross 4.7 billion, and then we will include you in this index, right? So in that way, they are reducing the volatility of the index itself. Otherwise, if it comes over here at 4.2, goes back in 3.9, you cannot keep on reconstituting the index like this. So they say, okay, you come at 4.7 billion, stay over there for 1 month, then we'll understand, okay, now your company is truly a large cap, and let's include you in the large cap, right? So this could be one of the scenario. We'll take another scenario, packaging. So now it's again in the same scenario. It says that it's 4.2 now. In the packaging, what happens? The portfolio gets migrated to large cap partially, and then later on next reconstitution date. So what it says is, so suppose I am benchmarking against these indexes and I have 400 million in holding. I'll say, okay, let me just move 20 million out of the and 10% of that was to be reconstituted. So say 40 million. So I'll say, okay, 20 million I will invest in this stock now, because since it's had moved from mid cap to large cap, and 6 months down the line, when the index gets reconstituted and this stock comes over here, I will invest the remaining 20%. So this way I am just being very cautious that this movement is not temporary and there is truly a large cap which is coming into a large cap index. So buffering and packaging, buffering is waiting up till a threshold, packaging is just buying in multiple packets. That's an easy way to understand. Hedged portfolio exposure, it's ranking based long short, not a pure factor portfolio. What it is saying that uh, based on the criteria, and you just rank the portfolio, all top performing over here, non top performing over here. So long these, short these, the middle are ignored. So this is a hedge portfolio, but this is not a pure factor portfolio, because obviously these stocks will have multiple factors, and a pure factor portfolio will have one coefficient to one factor and zero to others. But over here we can see there are multiple factors which are being considered. So it's not a pure factor portfolio. Then there is a Pearson information coefficient and Spearman rank information coefficient. So over here, the basic thing to understand is that whether the correlation between the factor exposure explains anything. Okay. So in the Pearson IC, the correlation between the factor exposure and the holding period return is sensitive to outliers. Spearman rank IC addresses the outlier issues. This is all we need to know. So if you are given in an exam question both the values, Pearson IC and Spearman rank IC, and the question asks you which is the better way, the answer is Spearman rank IC. And if it asks you what problem does it solves the issue of outliers. It's very simple to remember. Then we have the expected active return. Expected active return is a combination of transfer coefficient or transfer coefficient into information coefficient, the root of breadth into the standard deviation of the asset or the active risk. So this is a simple formula which is we are coming from level 2 also. So in case you want to compute the expected return of the active portfolio, what you do is transfer coefficient into information coefficient into root of BR into standard deviation of A or the active return. Mostly in the exam you will be given all these variables and you will be asked to compute the number of stocks or the number of bets that you have to take. So this is the number of bets, BR is the number of bets. The answer will be in a square root. You have to square at the final stage to arrive at BR. Very simple from the L2 itself. Active share and active risk. So I think so we are aware of this, but let's again try to cover this up. So I could have one portfolio, one benchmark. I can have 25% over here, same 25% over here. For simplicity perspective, let's take 35 here and 50 here and 25 in the last one. 35, 25 is 60, we'll take 40 over here. This is the portfolio, this is the benchmark. They might be invested in some sectors, different sectors with different allocation. Now what I'm saying that active share is sum of WB minus WB divided by 2. So I can say that WB minus WB, which is 35 minus 25 here, plus 35 minus 50 plus 40 minus 25, the entire by divided by 2 will be my active share. Active share. This is how I am differentiating against the benchmark. Then we have the active risk, which is the tracking error. It checks the consistency of returns. Two things to remember in the question, it could be confusing question. Active share can be controlled. Why? Because as a fund manager, I can have a control as to how much allocation I want to my security, right? If the security is looking good, I might want to over allocate, I might want to under allocate. It's under my control. But active risk cannot be totally controlled, right? Because say suppose today the active risk between the metal sector and the IT sector is say X, the correlation is X. Now I don't know what's going to happen in future. It could remain X, it could go to Y, which we have predicted, or it could go to Z, right? Whatever correlation it could happen. That is completely controlled by the market forces. So that's why active risk cannot be controlled. Active share can be controlled. Higher factor risk, higher active risk. So higher factor risk means if the two portfolios, the portfolio and the benchmarks, have different factors exposure. So if a higher factor risk, higher active risk, because the correlation will change. No factor exposure, active risk is due to the active share. So if you have a zero factor exposure, you have a market neutral portfolio. So there you don't have the active risk, and the active risk can be attributed to the active share, because in case I have the factors are same over here, the factors are neutral. Say both of the portfolio are exposed only to the market risk. So the risk that can arrive, or the return difference that can arrive, is only because of the weight of the portfolio. Both the portfolios have different weight. So if the factor risk is neutral, the difference in return will be attributed to the weights. So that is what they are saying. If there is no factor exposure, the active risk is due to the active share. Active risk attributable to active share is inversely proportional to the number of securities. That is, if there are lesser number of securities, then there is more active risk. Say suppose now I'll do say 35, 40, and over here I simply make this 25 and 75. Now we have lesser number of securities over here. So my active risk increases from 35 minus 75, right? Mathematically my active risk and active share both will increase, because now I have a concentrated position. Okay, so that was more from an active share, active risk. It's very easy to understand in that sense. The reason I've highlighted over here are because these are the questions which are very repetitive across mocks. So just have a look at this one. Then we have the risk budgeting and the contribution of assets. So what is risk budgeting? It's basically saying that which asset is contributing to how much risk in the portfolio. So in the exam, if you are given such a kind of an output wherein you are given the portfolio of the portfolio weights, and you are given the standard deviation of each portfolio, and you are given a variance covariance matrix, all you have to do is just apply the formula it's which is weight of asset A into weight of asset A into covariance of asset A with A with B, A with C, keep on summing it. Then divided by the total variation, you will get the weight of that asset or the contribution of that asset to the entire portfolio. This is for the covariance matrix. Again, the same formula applies in case you are given a factor based risk budgeting. Same formula. So it is simply coefficient of market into coefficient of market into the covariance of market with size, and similarly with the size factor. Just add both of them. Total variance is this much. Explained is this much. The difference will be the unexplained variance. Lastly, in the equity, if two portfolios have similar alpha skills, similar active risk, then portfolio with higher active share will be preferred. Now, this is a very important statement which says that if two managers have same logic to beat the market, so they have same alpha skills, they are taking on similar active risk. Like one is taking long in metals, the other is also taking long in metals, the other one is shorting the IT index, the second one is also shorting the IT index. Then what could be the differentiating factor of their return? The return differentiating factor will be the third parameter, which is the active share. If two managers are giving you 8% returns, taking 1% risk per unit, hypothetically, and one has an active share of 45 or say 4 in that sense, and the other has an active share of 9, you will prefer a portfolio manager which has higher active share because he is able to give you better returns by taking on more active bets because his active share is higher. That means he is challenging the benchmark and in essence saying that okay, benchmark return is XYZ, let me try to beat the market, and in the process of doing that he is creating a better alpha, a similar alpha but taking on higher active share. So if there are two portfolios with the similar risk and return, consider the portfolio manager with the higher active share. I will stop over here from fixed income and equity perspective. I will cover up some other subjects in the next video. Thank you.